So chapter 13 is an important chapter, and it focuses on one thing and one thing only. So all along you've been given R when you calculated the present value and the future value and the net present value. Now we are going to determine R based on what you learn in this chapter and be able to apply it to calculate net present value. So the cost of capital is the rate at which we discount the projects to determine whether or not they're a viable project. So we're going to be calculating R. So for our weighted average cost of capital calculation, we're going to be using the liabilities and equity section of our balance sheet. So just as a reminder, our assets have to equal liabilities plus our equity, and we're going to have in our simplified balance sheet here debt, which is total going to be total liabilities, and then we're going to have two kinds of equity: preferred stock and then common equity. Right, and the three of these together have to add up to total assets to keep that equation in balance. Opportunity cost is showing up again in this chapter, and it's going to be important in, we've seen it now probably almost every chapter, right? What are you giving up? What's the next best alternative? So when we're using and trying to determine this weighted average cost of capital, remember, we're going to be using it to determine viability of projects. So again, the opportunity cost is going to be important. So we'll get into a formula, but I keep saying weighted average. So weighted average cost of capital is a formula that we're going to be seeing here very shortly. And that's going to be equal to R, the interest rate that we're going to be using now in our net present value calculations. R is not changing per se, but before it was always given to you. Now you have to calculate it. What's going to be important is our market value of our balance sheet. So remember that the balance sheet is based on accrual basis accounting, and accrual basis accounting is based on historical cost. So everything's recorded at its historical cost. But historical cost and the current market value don't always coincide. So we're going to be restating the balance sheet based on the market values of the debt and the stock. So what this equation is saying is the market value of the equity plus the market value of the debt is going to be equal to the market value of the assets. So we're just adding market value in front of each one of those words. Assets still equal liabilities or debt plus stockholders' equity. So this equation is not nearly as confusing as it may look right now. But we're going to take the fraction of the firm's value that's financed by equity and the fraction of the firm's value that's financed by debt. The two of these things have to add up to 100%. We're going to take each one and multiply it by its corresponding cost. So the fraction of the firm that's financed by equity, we're going to multiply by the equity cost of capital. We'll calculate that a little later. And then the fraction of the firm's debt that's financed by debt, we're going to multiply by the cost of debt. And that's going to give us the cost of capital, or R sub W, the weighted average cost of capital. Okay, when we're talking about a levered firm, that just means that the firm has debt. So if the firm has no debt, and there are firms out there that have no debt, the chapter talks about them, right? They are not levered. So the first thing we're going to do is just learn how to calculate the weights, because that's the first parts of that formula. So suppose this corporation has debt with a book value of $10 million that's trading at 95% of face value. It also has book equity of $10 million and 1 million shares of common stock that are trading at 30 $30 per share. What weight should they use in calculating its weighted average cost of capital? Okay, so referencing that equation, 13.2, the weights are the fraction of the balance sheet that's financed by debt and the percent and the share that's financed with equity. So they have to add up to 100%. Now, another important thing is the weights have to be based on market values, not what's actually on the books. Remember, I talked about that a couple slides ago. So we can ignore the book values, right? That information's there, but you don't need it. So lots of times problems will give you information you don't need. This is one of those examples. To calculate the value of our debt, our market value, remember we're interested in market values. We're going to take the $10 million in debt, multiply it by the 95% of face value that it's trading at, and get a $9.5 million market value. So debt, make a little balance sheet, 9.5. Sorry, not good with writing with my mouse. And then we got the equity, right? So 1 million shares of stock at $30 per share is 30 million. You add up, we get a total of 39.5, right? We're going to need that total so that we can calculate our weight. So we want to know the 9.5 is what percentage of the 39.5. The 30 is what percentage of the 39.5. It's got to add up to 100%. When we divided the 9.5 by the 39.5 total, we get a 24.1% as the weight for our cost of debt. So 24.5% or 24.1% is the portion of debt that we have, and then the portion of equity that we have is 75.9 when we take the 30 divided by 39.5. You can always double check, right? The 79.5 and the 24.1 have to add up to 100. You have to account for 100% of that liabilities and stockholders' equity portion of your balance sheet. Now we will look at calculating the individual cost of the debt and the cost of the equity. So for debt, remember, debt's different than equity because you have to pay it back, and that interest that you have to pay is tax deductible. So it reduces your tax liability. So this is one formula where taxes will be important, and the tax rate is going to be given to you so that you can take that into account. So we're going to use yield to maturity, and that is the yield that the bond purchasers would earn if they held the debt to maturity and received all the payments as promised. So for our bonds, like we saw in previous chapters, that would be all the interest payments, and then the payment of the principal amount at the end. So our effective cost of debt is going to be R sub D, which is the rate on the debt, the interest rate that's on the debt, times 1 minus the tax rate. And that's the corporate tax rate because that interest is tax deductible. So that's going to reduce the cost of borrowing. So your effective rate for your cost of debt has got to be less than R sub D, the rate that was on the debt, because of that tax benefit. So if we want to calculate this, we have a problem here. It says by using the yield to maturity on AT&T's debt, we found that its pre-tax cost of debt is 3.18%. If AT&T's tax rate is 25%, what is the effective cost of debt? So the effective cost of debt is going to be equal to R times parentheses 1 minus the tax rate. So R is going to be 3.18%. multiplied by 1 minus the 25% tax rate. And we're going to, well, it's probably on the next slide, but we're going to solve that and that will give us the effective cost of debt. It's got to be a number less than 3.18%. If you do the calculation and you get something higher than 3.18, you know you've done something wrong. They're going to break it into a couple different slides here. So what they're telling you, right, is they're taking the information from the problem, identifying the variables. It's a good idea, a good practice to get into. So the effective cost of debt is going to be R sub D 1 minus T, the tax rate. We get 2.385. We want to ask ourselves, does this answer make sense? It's got to be less than 3.18, and it is. All right, I see that our formulas aren't showing up again. It's funny how some of them will show up and then others won't. Okay, so equation 3.4 is the equation for the cost of preferred stock. Your chapter walks you through, right, a formula that we learned earlier in the semester. And we're just solving for R. So the cost of the preferred stock is going to be equal to the amount of the dividend divided by the stock price. So super simple. We're assuming there's no growth, and there's generally no growth with preferred dividends because, right, preferred stock has a stated dividend rate. So if we want to calculate the cost of the preferred stock, given the fact that the stock price is $25.43 and the dividend's $1.37, we take the $1.37, we divide by the $25.43 price, and we come up with a rate of 5.39%, which your slide shows if you printed it out. We're going to have two different ways we can calculate the cost of the common stock. It's going to give you two different answers, and that's fine, right? Every time we have a different way of calculating something, it gives us a level of confidence that we're in a certain range. There are no absolutes here, right? We're trying to get in a range. So the first way we can do it, and I know don't get caught up on this chapter 12 and then we did or did not do it. We're going to look at a pretty simple formula that is based on the capital asset pricing model. That's CAPM abbreviated. So the firm's beta, which tells us how risky it is relative to the home market. And we look at the market risk premium, how risky is our stock compared to the market. And then we also incorporate a risk-free rate. All you have to do is worry about the formula. You'll be given all the information, just have to plug it in the simple formula and calculate the cost of equity. So using this capital asset pricing model, we come up with this pretty basic formula. So the cost of equity is equal to the risk-free rate plus the equity beta times the market risk premium. Right? So this is in parentheses. Right? You have to do the beta times the market risk premium. You have to do that first, then add it to the risk-free rate. So to look at an example here, we have a equity beta for AT&T of 0.6. The yield on the 10-year Treasury note is 3%. Treasury notes are generally thought of as a risk-free asset. There is no chance of the U.S. government defaulting on that asset. And then you have a market risk premium of 6% based on this stock. So to calculate AT&T's cost of equity, we have the risk-free rate plus the beta times the market risk premium. Right? You have to do this. It's in the parentheses, and then add the 3%. You come up with 6.6%. So not nearly as complicated as it sounds. Another model that we can use to calculate the cost of the equity is the constant dividend growth model. So again, we're taking the information that we had in previous chapter and we're just rearranging it to get the cost of the equity. R is going to be equal, and hopefully again the formula is showing up on your page. It's the dividend in year one, so 1 year out, divided by the current price plus G. Right, so all this is a rearranging of the previous formula you had in the previous chapters, right, where you calculated the price. Right now you're using the price to calculate the R value. So we have another example here. We have the average forecast for AT&T's long run earnings growth was 2.85%. So growth is G in our formula with an expected dividend in 1 year of 2.04 and a price of $32.20. We can use that equation now to calculate the cost of equity. This slide does a nice job of summing up the two different models. Remember, we're using either model to calculate the cost of the equity. Now, if you're using the capital asset pricing model, we need 3 different inputs. We need the beta, we need the risk-free rate, and we need the market risk premium. So some assumptions for this model is that the estimated beta is correct. Right, there's no absolute way of determining whether it's correct or not. It's based on a range. The market risk premium is accurate. Again, markets change all the time, so that risk premium could also change, and that the capital asset pricing model is the correct model to use. If we're using the dividend model, right, first off, you have to be paying a dividend, and not every stock will pay a dividend. So things that you need for that, oops, sorry, I drew the long. We need the current stock price, we need the expected dividend next year, and the future dividend growth rate, right? And when this is looking into the crystal ball, we don't have any evidence that we know what's going to happen in the future. We can only base that on what we know has happened in the past. So some major assumptions for this model, the dividend estimate is correct. Again, we're looking into the future, so we don't know that for absolute certainty. The growth rate matches the market expectations. We can't guarantee that. And that the future dividend growth is constant, and that might not happen. So you can see there's a lot of assumptions that go into these models. And so you have to understand those assumptions to know that you're not coming up with a concrete guaranteed result. We're going to use the two models now to calculate the cost of equity both ways. So given our information here, so we have the equity beta for Johnson & Johnson is 0.55. The yield on the 10-year treasuries is 3%. That's going to be our risk-free rate. And you estimate that the market risk premium is 6%. Okay, Johnson & Johnson issues dividends at an annual rate of $2.81. Current price is $92, and you expect dividends to increase at a constant rate of 4% per year. Estimate Johnson & Johnson's cost of equity 2 ways. So we have the capital asset pricing model, and then we have the dividend model. So this slide just repeats what I just said. There's 2 ways, CAPM and the constant dividend growth model. So for CAPM, we need the risk-free rate, the beta, and the market risk premium. And we're going to use the 10-year treasury note as our risk-free rate. The second model is the constant dividend growth model. We need the current stock price, the expected dividend next year, and an estimate of the future growth for the dividend. They list here each of the variables and the information that corresponds with it, so we can substitute them in to each of the equations. Again, this should show up on your slide. When we calculate the capital asset pricing model, we're going to have the risk-free rate, 3%, plus parentheses, the beta 0.55 times the market risk premium of 6%. You do the math, should get CAPM of 6.3%. When we use the constant dividend growth model, we're going to get the dividend of $2.81. We're going to divide by the current price of $92, add the growth rate of 4%, we get 7.1%. It's a little less than 1% difference between using the two different models. Right, they're not going to produce the same answer. It's highly unlikely that they would, but they do produce an answer that gives us some level of assurance that we're in the ballpark. We can evaluate our answer and look at what would be the required dividend growth rate that would make the two converge and make them the same. I'm not terribly concerned about them being the same, but in the event that you want them the same, to have some level of confidence, or just to say, okay, what would the growth rate have to be in order for them to be the same, right? You can do the math as it shows here, right, and determine that the dividend growth rate would have to be 3.2%. Then if that was the case, then they would both give you the same cost of equity estimates. But again, it's just an estimate. We can rewrite our weighted average cost of capital equation into this format. So we have our rate of return for our weighted average cost of capital is equal to the return on the equity times the percentage of equity, the return on the preferred stock times the percentage of the preferred stock, times the return on the debt times the percentage of debt. So the percentage of E and P, preferred stock and debt, have to add up to 100%. So if a company that does not have preferred stock, right, we're just eliminating this factor here, and the formula simplifies to what we saw previously. They're rewriting it and relabeling it as equation 17 or 13.7, but it matches up to equation 13.2 also, except they're rating it in variable terms instead of words. We're going to put it all together now. So in 2019, the market value of AT&T's common stock, preferred stock, and debt were $234,560 million, $2,185 million, and $176,505 million, respectively. Its total value is what we get when we add all three up. So $413,250 million. $413,250 million. Okay, so now we need to know which portion of the debt, 234,560, is and divided by the 413. And then we're going to take the preferred stock, much smaller portion. What portion is that of the total 413,250? And then what portion is the debt? I think I might have had them out of order. So it's common stock first, then preferred stock, then the debt. So given the cost of the common stock, we're going to use the CAPM estimate that we calculated earlier. and the information that we just were given, we can compute the AT&T's weighted average cost of capital in 2015 as follows. So we're going to take the 6.6% RSB, and we're going to multiply it by the percentage of equity that equity is of the total, 413,250. And then we're going to take the cost of the preferred stock, the 5.39%, times the proportion of the preferred stock of that total 413. And then we're going to take our return on the debt, 3.18%. Remember, we have to take the taxes into consideration. So the 25% tax bracket is included there. And then the 176,505 divided by 413,250. So it's just a matter of plugging the numbers in the right places and then doing the calculations in your calculator. So we come up with a weighted average cost of capital of 4.8% for AT&T for 2019. So this slide is showing you the equation, everything plugged in, just as I said on the previous slide. There are a couple things that can complicate our use of the weighted average cost of capital. One of them is, in practice, this idea or notion of net debt. So when we were looking at our balance sheet, right, we were solely focused on the liability and stockholders' equity side of that balance sheet. We did not look at how much was on the asset side. We know what the total was, but we don't know how it was broken out. So there are some arguments that we should use net debt in our calculation to calculate the weights. And net debt is equal to the total debt minus the cash and the risk-free securities, which are securities we could turn into cash pretty quickly. So cash equivalents. The reason being is that when you have some companies may have a lot of cash on their books, and they could use that cash to pay off that debt. So it could artificially be affecting your numbers. So the argument is, if you take away that, if you use net debt in your calculation for a firm that's got substantial reserves of cash, this could be an important adjustment because it will reduce the amount of overall debt and put a higher weight on the equity and a reduced weight on the debt. Another issue in practice is the use of the risk-free interest rate in the CAPM model. So most firms use the yields on the long-term treasury bonds. Now, part of the problem is these treasury bonds range from 10 to 30 years. So you could get some slight differences depending on whether you picked a 10-year bond or whether you picked a 30-year bond. And then another issue is the market risk premium. So, looking at the stock market over time, we can see that there's some variation. So since 1926, the S&P 500 has produced an average return of 7.7% above the rate for the one-year treasury securities. But after 1962, or since 1962, that has only been 5.5% over the one-year treasury security. So depending on the length of time that you use in determining that market risk premium is going to affect the value that you get. So there's some arguments that the 5.5% is more accurate, and right, but then there's some arguments that say, well, going back to 1926, that includes the Depression, so that must be, if it can take that into consideration, then that must be a more long run estimate that would be better to use. So there's a lot of different opinions about this. You can spend a career calculating these kinds of things. So we're going to use the weighted average cost of capital to value a project. So just some differentiation here, explanation to get started. Remember, levered means that they have debt. So the value of an investment, including the benefit of the interest tax deduction, giving the firm's leverage policy. So the leverage policy is how much debt the firm is willing to take on. The weighted average cost of capital valuation method is discounting future incremental free cash flows. Does that sound familiar? It should, using the firm's weighted average cost of capital. Before, R was always given to you. Now we've just spent a bunch of slides determining the best ways to calculate R. So we're going to discount our incremental cash flows by our weighted average cost of capital to determine our valuation for our project. This should sound familiar because this is a net present value. So the value, that's B, of our leveraged project, that means we have debt at time period 0, is going to be equal to the free cash flow in time period 0 plus the free cash flow in time period 1 discounted back 1 year plus the free cash flow in time period 2 discounted back 2 years, etc., etc., etc. Okay, this is exactly the same as calculating the net present value. The next few slides just highlight some key assumptions. So first is the idea of average risk. We're going to assume initially that the market risk of the project is equivalent to the average market risk of the firm's investment. So the project that we're valuing is not any more risky or any less risky than any other project that we're doing. Okay, the second assumption is constant debt to equity ratios. We assume that the firm's has adjusted its leverage continuously to maintain a constant ratio of market value of its debt to the market value of its equity. So what we're saying here is those percentages won't shift, which is not going to change the weighted average cost of capital, which is not going to change the valuation of our project. So these debt to equity ratios are going to maintain or be maintained within a certain level that is not going to wildly fluctuate that would change our decision making. A third assumption is that we have limited leverage effects. So we're assuming that initially the main effect of the leverage on valuation, right, this is the percentage of debt that we have, follows from the interest tax deduction, and that any other factors are not significant at the level of debt chosen. Right, so if you go back and think about what we learned in our bond chapter about all the different levels of risk with the different bonds based on the firm's standing, right, the AA, AAA, the rating system. So what we're saying here is that there's not going to be any effect on that level of risk based on the debt. To summarize these assumptions, they are reasonable for many projects and firms. So a lot of times when we have certain assumptions built in, they could be detrimental, but these are really reasonable assumptions for most cases, and every case that you're going to have in this book. So the first assumption is likely to fit the typical project of firms with investments concentrated in a single industry. And if you're trying to go into a different industry, you can't use your current values to determine the effects of that project because it's not inside the industry that you're currently in. The second assumption reflects the fact that firms tend to increase their levels of debt as they grow larger. So increased levels of debt become less risky the larger the firm is. And the third assumption is especially relevant for firms without very high levels of debt, where the interest tax deduction is likely to be the most important factor. Because remember that interest is tax deductible, it's going to reduce our tax burden. And a lot of times that in itself will be the decision to go with debt financing versus equity financing because of that reduction. Now, that does come with risk because you have to pay the interest. So to summarize, we're going to determine the incremental free cash flows of an investment Okay, we learned how to do that in the previous chapter. We're going to compute the weighted average cost of capital. We just learned how to do that in this chapter. And then we're going to compute the value of the investment, including the tax benefit of the leverage, by discounting the incremental free cash flows using the weighted average cost of capital, and that's going to give us the net present value. So, right, we've taken everything we've learned in this chapter here, number 2, and we're combining it with things we learned in previous chapters, to do items number 1 and items number 3.